This AI-generated podcast is for general information only and does not constitute financial or legal advice. Please consult a qualified professional.
Welcome to the Luxembourg Fundcast. Produced by Bertrand Mariaux, a regulatory lawyer qualified as Avocat à la Cour in Luxembourg and Paris, this show brings you reliable insights on Luxembourg regulations sourced from curated official references. This episode is current as of May 2026.
Thank you.
So, if you are a regulatory counsel or, a fund manager or operational director listening to this right now, you already know that onboarding an investor is never just some simple signing exercise.
Oh, definitely not. I mean, it is highly complex.
Exactly. And have you ever actually considered why the precise sequence of signing a fund subscription package is, fundamentally critical to legal certainty?
It is the absolute core of the process.
Right. So today we are doing a masterclass, a real deep dive into the Luxembourg private fund subscription package. We are dissecting it strictly as a critical regulatory and operational control point.
Because it really is the central control point. Yeah, because when a private banking client, for instance, seeks to enter a Luxembourg private fund, this specific signing package carries an immense legal burden. Getting the mechanics wrong introduces some really significant legal risk.
It absolutely does. I mean, to properly frame our masterclass today, there are really three fundamental takeaways that you need to keep at the forefront of your execution strategy.
Okay, let us break those down. What is the first one?
First, we must establish the strict legal distinction between the three components of the package. You have the subscription agreement, which is basically the formal application to invest.
Right, the application itself.
Exactly. Then you have the commitment, which is the fixed ongoing funding obligation. And finally, you have the representations, which provide the binding evidence of eligibility, authority, risk understanding, and compliance status.
Okay, so application, funding obligation, and the binding evidence. Got it. What is the second takeaway?
The second is the well-informed investor status. So specifically for reserved alternative investment funds, specialized investment funds, and investment companies in risk capital.
And this is not just some marketing label, right?
No, absolutely not. It is a strict legal perimeter dictated by Luxembourg vehicle law. It is literally a statutory boundary that dictates who is legally permitted to be in the fund.
Wow, okay. And the third takeaway, you mentioned private banking clients earlier.
Yeah, so the third takeaway relates directly to that private banking context. When an investor comes through a placing bank, the fund subscription file and the bank's investment service file, they must perfectly align.
But they are not the same thing.
Precisely. They remain two entirely distinct document sets that serve completely different legal obligations.
Okay, I actually want to pause on that very first takeaway because it really sets the foundation for this whole deep dive. For those of us reviewing these files, why is it so critical to legally separate the subscription from the commitment?
It is a great question.
Because, in the public markets, if you buy a share, you just pay for it immediately. Why the distinction here?
Well, that distinction is really the bedrock of private markets. I mean, in a private alternative investment fund, the fund does not typically deploy all the capital on day one.
Right. They call it as they need it.
Exactly. Therefore, the subscription agreement forms the overarching contractual relationship, but the commitment is a binding pledge to provide a specific amount of capital over a set period.
So the funding actually happens over time through capital calls.
Right. So the legal obligation is ongoing. If the documents do not clearly separate the application to be a partner from the strict contractual obligation to fund upon request, you have a major issue.
Fund couldn't enforce the capital call.
Exactly. The fund's ability to enforce a capital call against a defaulting investor is severely compromised.
That makes perfect sense. The legal mechanics actually reflect the operational reality of how the capital is used.
Yes, they have to align perfectly.
So, regarding your third takeaway about the private banking context, if you are an investor coming through a placing bank, that bank is already generating a massive suitability file under the Markets in Financial Instruments Directive 2.
Yes, commonly known as MiFID II.
Right, MiFID II. I can hear operational teams asking right now, if the bank has already done a full suitability check, why does the fund have to do this all over again? Is that not just duplicative work?
It might look duplicative from the outside, but legally it is really not. The MiFID II suitability file addresses the bank's regulatory obligations to its client.
So that is strictly between the bank and the investor.
Exactly. The bank must assess the client's knowledge, their experience, financial situation, and investment objectives to ensure the advice or portfolio management is suitable.
But the fund has a different set of duties.
Right. The fund subscription file addresses the fund's regulatory obligations regarding its investor base. The fund manager has a strict duty to ensure that every single entity on its register legally qualifies to be there under Luxembourg law.
Regardless of what the placing bank's internal files say.
Yes. I mean, the two files must be consistent. You cannot have a bank categorizing a client as retail while the fund accepts them as professional without the proper qualifications. But one does not legally replace the other.
Okay, so we have these strict definitions and very distinct duties, but, cross-border distribution complicates everything.
Oh, it certainly does.
I mean, if an investor is sitting in Germany buying a Luxembourg fund through a Swiss bank whose rules are actually protecting them, how do the jurisdictional scopes engage here?
Well, the rules engage on a European level, specifically when an alternative investment fund is marketed within the European Union or where the placing bank provides method to investment services.
So European rules step in. But what about the Luxembourg regulator's view?
Right. So if we look at the underlying policy objective formulated by the Commission de Surveillance du Secteur Financier, the CSSF, it is entirely focused on orderly, transparent investor protection.
And how does the CSSF framework achieve that?
It provides an incredibly robust, reliable environment. Under Article 21 of the Luxembourg Alternative Investment Fund Managers Law, there is a strict mandate for pre-investment disclosure.
Okay, let us dig into that. What exactly does that pre-investment disclosure entail in a concrete scenario? I mean, what is the standard we are aiming for to cure that information asymmetry?
The standard is that the investor must possess a clear, really comprehensive understanding of the fund's strategy, the liquidity profile, the valuation methods, and the fees.
So they need the full picture before signing.
Exactly. The legal relationships and the specific service providers, all of that must be understood before they become legally bound. I mean, this is not about overwhelming them with data. It is about providing material facts.
And I assume this ties back to that vehicle-specific perimeter you mentioned.
Yes. Furthermore, as we touched on earlier, investor eligibility for a reserved alternative investment fund, a specialized investment fund, or an investment company in risk capital is governed separately by the specific Luxembourg vehicle law applying to that structure.
Which brings us to the operational reality of timing. Because, in practice, the sequence of events is exactly where legal vulnerabilities emerge.
Timing is everything in execution.
Right. So at what exact legal moment must these protections and disclosures crystallize?
The critical legal moment is strictly before the investment becomes binding. If we take a reserved alternative investment fund, or RAIF, as our primary example, the offering documents must contain sufficient information for an investor to make a fully informed judgment.
And they have to have that before they sign the subscription agreement.
Yes, strictly before. And importantly, the CSSF requires that the essential elements of this offering document be kept meticulously up to date.
So you can't just rely on an old prospectus.
No, not at all. If there is a material change in the fund's strategy or risk profile, the document must be updated before any additional securities or partnership interests are issued to new investors.
Right, because you cannot hand an investor a 2-year-old offering memorandum if the operational reality of the fund has shifted.
Exactly. That would be a fundamental breach of the disclosure mandate.
So execution clearly requires extreme discipline. How does an operational team actually ensure compliance with both the pre-investment disclosure mandate and the strict investor perimeter?
It requires a highly structured process.
What does that execution architecture actually look like day to day?
Well, execution is built on a rigorous 3-layered approach. Layer 1 is the documented delivery of the offering and disclosure documents.
So keeping an audit trail.
Right. You need a verifiable audit trail showing what was delivered and exactly when. Then layer 2 is the collection of the subscription agreement itself, the fixed commitment, and those binding contractual representations regarding eligibility and authority.
Okay, delivery, then collection. What is layer 3?
Layer 3 involves the completion of permanent structural pillars. Here, I am referring to the anti-money laundering, counter-terrorist financing, know your customer, and tax self-certification checks.
I really want to dig into that third layer because, we often see anti-money laundering, or AML, treated as almost a secondary compliance check rather than a fundamental pillar.
Which is a very dangerous misconception.
Yeah, so what happens if a fund accepts the money and countersigns the subscription agreement before the AML checks are fully cleared?
Well, that is exactly the scenario that strict Luxembourg regulations are designed to prevent. The CSSF views AML and counter-terrorist financing duties as absolute requirements.
They are optional.
No, they encompass customer due diligence. identifying the ultimate beneficial owners, maintaining adequate internal management, and, ensuring full cooperation with authorities.
So if a manager jumps the gun,
If a fund manager accepts an investor onto the register and calls their capital before those structural AML checks are finalized, they are in breach of core regulatory obligations.
so the sequence really is mandatory.
Absolutely mandatory.
Right.
The AML and tax checks must be fully complete and reconciled before the fund accepts the investor.
This moves us perfectly into how practitioners translate these strict requirements into daily operational reality.
This is where the playbook really matters.
Yeah. I mean, if I am an auditor or a compliance officer reviewing a subscription file, what is the concrete test I'm actually applying?
The core operational question you must ask yourself is this: does the file definitively prove that the right investor received the right documents, made the correct binding representations, committed the exact right amount, and was formally accepted by the right party?
Meeting that standard across, say, hundreds of investors seems like an immense administrative undertaking.
It is a massive undertaking.
How does an operational team actually reconcile all of this without missing a fatal flaw?
It requires an exhaustive, truly systematic reconciliation process. The subscription package can never be viewed in isolation.
So they are cross-referencing constantly.
Exactly. When a compliance officer is reviewing the file, they are cross-referencing the signed representations against the offering memorandum and the limited partnership agreement to ensure the investor type is permitted.
What about special deals with specific investors?
Right. So they are also checking it against the fund's side letter policy. If an institutional investor negotiates a side letter for specific reporting rights or fee discounts, the execution team must ensure those terms do not violate the most favored nation clauses granted to other investors.
That sounds incredibly complex, and they still have the AML side to deal with.
Yes. Finally, they're executing the strict sanction screening, reconciling the beneficial ownership files, confirming the tax forms, and verifying the payment mechanics.
Let's introduce a variable that fundamentally alters this playbook. What happens to this execution architecture if the investor attempting to subscribe actually falls into the retail category?
Well, if the investor is retail and the product qualifies as a package retail and insurance-based investment product, or pre-I, you trigger an entirely new, strict pre-investment requirement under European regulations.
A kid, right?
Exactly. A key information document, known as a KID, must be provided to that retail investor in good time before they are bound by any contract or offer relating to that product.
And this document is highly regulated.
Yes, the KID is a highly standardized, strict document designed to explain risks, performance scenarios, and costs in a very specific format.
So timing is an issue here again.
Completely. Without documented proof that the KID was provided in good time prior to the subscription, the onboarding process is invalid.
Naturally, this level of disciplined execution, especially when you're managing distinct retail and professional workflows, it really impacts the operational architecture and the costs.
Oh, it definitely drives up structural costs.
How should a fund manager break down the cost and tax implications of this whole onboarding process?
Well, logically, costs in this space are divided into two main categories. Legal costs are highly variable. They depend entirely on the scope of the distribution strategy, the volume and complexity of the investors, and crucially, any remediation needs if the initial documentation is incomplete.
Right. Fixing mistakes is expensive. And the administrative costs.
The administrative costs, however, are generally fixed. They depend upon the specific service provider chain the fund manager has established. The central administration, the registrar, and the transfer agent.
Okay. And what about the tax documents they collect?
Regarding tax impacts, we really need to clarify the exact function of tax self-certifications at the subscription stage.
Because investors sometimes misunderstand this.
They do. Documents like AFC or CRS forms are absolute documentary necessities driven by international classification requirements. They are mandatory for the file to be complete, but they are categorically not a substitute for actual tax advice.
So the fund is not advising them.
Right. The fund is collecting them strictly for reporting compliance, not to advise the investor on their personal tax liabilities.
Okay, so having built this really comprehensive playbook today, from legal definitions down to the operational reconciliation, we need to look at the broader context.
The market reacts.
Yeah. What is the current regulatory radar and market pulse telling us right now? How are practitioners and authorities currently interacting with these execution standards?
Market practice has firmly, and I would say correctly, adopted the subscription pack as the central, crucial control point.
It is the anchor of the whole process.
It is universally treated by top-tier practitioners as the mechanism that definitively links distribution status, tax classification, AML evidence, and contractual enforceability.
And what about the regulator? What is the CSSF focusing on right now?
Looking at the current supervisory focus from the CSSF, the market pulse is one of robust stability regarding these specific rules. Based on a review of official supervisory news, there have been no structural regulatory shifts in the last 48 hours concerning the subscription agreement sequence.
So just to be clear, the regulator is not currently trying to rewrite the fundamental rules of subscription.
Exactly. The supervisory focus remains entirely on the disciplined, accurate execution of the existing framework. The CSSF provides very clear guidance, and their expectation is simply that market participants follow it rigorously.
They just want to see it done right.
Yes. In fact, recent regulatory updates displayed around this period have concentrated on entirely different areas of the financial sector. Specifically, money market funds and the publication of the Luxembourg law transposing the capital requirements Directive 6 package.
Okay, so given that current market stability regarding subscription protocols, what timeline should regulatory counsel and fund managers be preparing for next?
That is the million-dollar question.
Right. Are there any scheduled fixed-date changes to this specific sequence that we need to be actively aware of?
Based on the reviewed official sources, no specific fixed-date changes have been identified for this subscription agreement, commitment, and investor representation sequence.
So nothing officially on the calendar?
No. Therefore, any future modifications to this specific signing package are strictly date TBC.
Which means the immediate strategic priority is not, trying to anticipate a new rule tomorrow, but rather ensuring absolute mastery in the application of the current framework today.
Precisely. The emphasis must remain on mastering the execution of the rules and processes we have just detailed.
To really bring this entirely into focus for our listeners, let's close out this deep dive with a holistic scenario-to-execution narrative.
I think that would be very helpful.
Yeah, walk us through the operational reality from start to finish, applying everything we have discussed.
All right, let us take the scenario of a private banking client who wishes to enter a Luxembourg RAF. As we establish, this is not merely buying a product off a shelf.
It is an integration into a legal structure.
Exactly. The operational reality requires the fund's service providers to build a comprehensive legal file. This file must explicitly connect the investor's documented status with the fund's legally permitted investor base.
And it connects the different parties, too.
Yes, it must connect the bank's distribution record with the fund's formal acceptance process, ultimately culminating in the registrar's definitive records.
And what are the final definitive execution steps before that formal acceptance by the general partner or the fund manager can actually occur?
The practical work culminates in a strict series of final legal checks. The compliance team must actively confirm and document whether the investor qualifies as institutional, professional, or otherwise well-informed under Luxembourg law.
And what if they are relying specifically on that well-informed status?
Crucially, for those relying specifically on the well-informed investor status under the relevant vehicle laws for a RAI, a SIF, or a SICAR, the team must document either the 100,000 euros minimum investment threshold, or they must secure the qualifying expertise assessment.
That assessment is a formal document, right?
Yes. This assessment is typically a certificate from a credit institution, an investment firm, or a management company. It formally states the investor's expertise, experience, and knowledge to adequately appraise an investment in the fund.
And then, of course, the AML checks.
Finally, yes, the team must verify that all AML, counter-terrorist financing, and tax records are entirely complete and reconciled. Only when that entire matrix is verified can the fund formally countersign and accept the subscription.
It really is a dense, highly interlocking system of legal and operational verifications.
It leaves no room for casual errors.
Which brings us to one specific, highly objective conclusion about the jurisdiction itself. Luxembourg is strategically relevant because its private fund framework combines flexible vehicles with a disciplined investor perimeter and a dense service provider execution chain.
And, that combination is exactly what ensures the final file is not merely signed, but is fully capable of being read, audited, and legally relied upon by regulators, general partners, and institutional stakeholders alike.
Before we wrap up this deep dive, here's a final thought for you to consider as you review your own execution processes.
A look to the future.
Yeah. As these subscription packages become increasingly digitized and operational teams begin relying on automated workflows to parse these documents, who actually holds the liability when an algorithm misreads a well-informed investor threshold or fails to reconcile a complex beneficial ownership structure?
That is going to be a huge issue.
It really is. It is a fascinating intersection of strict statutory law and emerging technology that every compliance officer will need to navigate very soon.
Absolutely.
Follow on Apple Podcasts, Spotify, or wherever you get your podcasts. Subscribe to Bertrand Mariaux and Rigor Media on YouTube. Connect with Bertrand on LinkedIn at bertrandmariaux.com. All links in the show notes. This was the Luxembourg Fundcast.